for listening to the Archbridge podcast. I'm your host, Ben Wilterdink, and today I'm joined by Victor Hwang. Victor is the founder and CEO of Right to Start, a campaign fighting to rebuild the economy by making entrepreneurial opportunity available to all. And he's also the founder and CEO of Victor & Company, an economic growth consultancy. Previously, he was the Vice President of Entrepreneurship at the Kauffman Foundation, where he led initiatives that impacted over 200,000 entrepreneurs. Victor, thanks for joining us today.
Thank you, Ben. It's a real honor to be here.
Well, I want to get right into it. The Right to Start campaign is something I mentioned. It's something that's how I kind of found you and came across your profile, and I really like what you guys are doing there. So I'm hoping you can kind of just give us the lay of the land. What is the Right to Start campaign? What's the goal that you're hoping to accomplish, and why did you start it? Why did you think that was an important thing to be working on?
Right to Start is a campaign to make entrepreneurial opportunity available for everybody, regardless of who they are or where they're from, regardless of race, place, or background, because we believe it's a fundamental right. Just like you have a right to speech, you have a right to worship, you have a right to assemble, you've got a right to start, you've got a right to be entrepreneurial. In fact, America was born as a startup nation with this idea that everybody should have the chance to be able to control their own destiny. But we've kind of lost that. If you actually look at what's happened in America in the last few decades, the data actually bears it out. The rate of entrepreneurship in this country has fallen. We're about half the rate of entrepreneurial activity in the country that we were about from the 1970s. That's census data. That's like, real. It's as rigorous the data as you get. If you look at the share of the population, there's fewer and fewer people working in small businesses today, more and more people working in large corporations. And so you can see the shift in the economy that's happened over time. And yet, at the same time, in the last few years, we know how important entrepreneurship is. We know it's the source of almost all net job growth. That is, older businesses, they compete with each other and they cancel each other out, and they either net zero or net negative in jobs over time. It's the young businesses that create the jobs. We also know it's the source of GDP, that it's the small firms that are the most innovative firms that actually drive the innovative products that become the growth of the economy. And we also know it's a way to fight inequality. We know it helps fight poverty. And we know that more entrepreneurs actually raise income levels. The more entrepreneurs you have in a community, the higher incomes go. For every 1% increase in entrepreneurs in a community, that's a $400 increase on average per household in a community. And so there's this disconnect in America where we know how important entrepreneurship is. The country was born as a startup nation. In fact, the Boston Tea Party was an entrepreneurs' rebellion of entrepreneurs saying, we want the right to be able to control our own economic livelihoods. Yet at the same time, we've neglected this issue. It's actually fallen away by the wayside. And we see the rates of entrepreneurial activity that have fallen, and we see the net result of it in the economy. And so what we're trying to do is say, let's bring this back. Let's make this an issue again. This should be something that's it should be a top issue in American life. It should be something that candidates talk about at the federal level, at the state level, at the local level. We should have economic strategies on this. But if you look at the way entrepreneurship is treated, it's kind of ignored. It's actually something where we just assume or we take for granted that the entrepreneurs will find a way to take care of it on their own. But we've made it harder and harder for them to do that. And so Right to Start is really focused on how do we make it easier for entrepreneurs to be entrepreneurs, to start and grow and succeed. And what can we do as a society to protect and nurture that? Yeah,
I love that. And I think, as you were describing, entrepreneurs, new businesses, they create the bulk of the jobs, the new jobs that are coming out. And, I think as we kind of all agree, I mean, a job is really important. At Archbridge, we're really focused on, how can we better help people climb the income ladder, particularly across generations. And if you're not talking about jobs and employment in that picture, you're missing the mark there. So I think that's super important. And the innovation stuff is also really important. Driving higher living standards, ensuring competition. Obviously, that all helps the consumer. So you mentioned the decline in new startups, the decline in new business formation. The decline in business dynamism is something that we've talked a little bit before about on this program, and is certainly something that's discussed in policy circles. And so you mentioned, we've made it harder for entrepreneurs to get started and to really start that. So do you think that this decline is something that is a result of new barriers that have been put in place in front of entrepreneurs, or is it sort of a cultural, a relic, or is there is there something else going on here, which is sort of the changing nature of markets in sort of an information economy where things tend to aggregate and conglomerate? That seems to be a trend in the past couple of decades. So maybe it's some mix of it. So maybe I guess I'll try to narrow all that down to a question here for you. But what do you think are the key drivers of that decline in business dynamism?
That's the trillion-dollar question, I think. And we've actually looked at that. When I was at Kauffman, we did research on this, and a lot of folks have been studying this question. And the answer is it's multifaceted. There are many different factors driving it. And so you can kind of answer the question both in the micro and the macro. In the micro, it's 20% of people who think about starting a business don't do it because they don't have easy access to healthcare, for instance. A big chunk of them can't do it because of debt. A big chunk of them can't do it because of lack of access to childcare. A big chunk of them can't do it because they can't find capital. So there's a bunch of reasons, and you can sort of parse it all out. But then there's a macro reason, because it sort of begs the question, well, how has this happened? How has this accreted over time? And the macro answer is we've just sort of ignored it. We've taken it for granted over time because we assumed, well, America will do this. I mean, America's always been entrepreneurial. It's in many times the things that you do the best are the things you take for granted the most. And one great analogy that people use is around pebbles in a stream. So, if you throw a pebble in a stream, it doesn't do that much to a stream. But if you throw lots and lots of pebbles, eventually the stream gets dammed up. And what's happened is we've actually dammed up the stream of entrepreneurial energy in this country through lots of pebbles. And so every single thing, every additional restriction on an entrepreneur, every barrier that's put in their way, every entrepreneur that is stuck in a system that isn't making it easier for them becomes part of a problem. And that those pebbles have actually slowed it down. And so you can point to lots of things. Another example is community banking. So the small community banks have been almost decimated in the last few decades. And there are very few little banks that are starting right now. And so what's happened is the entrepreneurs that normally would have not been bankable by a large bank, but would have relied on a community bank that knew them and had some relationship with them. Right. They haven't been able to get the basic capital. And that's not even like risk capital. That's basic banking capital that even entrepreneurs can't get access to now. And so you can look at across all these shifts in the economy. And then there's the macro shift as well, just around shifting, as you were saying, to a knowledge economy. From an asset-based industrial economy to a nimble knowledge-based economy means you've got to shift all the systems along with it. And we just haven't done that, frankly. We've assumed that entrepreneurs would find a way, but we're finding out they don't. It actually doesn't really work that easily, and we've got to pay attention to it, or we're going to harm our seed corn. Right. Yeah. No, that makes a lot of sense. And I think, we'll return to maybe a few of those different pebbles and we'll take a little closer look at them. But I think that's a great analogy. I want to kind of step back a little bit. In 2012, you and your co-author, Greg Horowitz, wrote a book called The Rainforest, The Secret to Building the Next Silicon Valley. So in that book, you talk about the nature of innovative ecosystems, and the rainforest is sort of the metaphor you settled on. Can you explain a little bit about what you meant by that and sort of how the rainforest applies in a business context? Sure. So the way that economic development has been done for decades, not just in the U.S., but really across the world, was a focus on trying to build big innovative corporations that could drive and lift up everybody else. And what we do in the book The Rainforest is start to analogize that to the planting of crops. So like on farms, what you want to do if you want to build great crops is you want to maximize the yield of farms. And so if you know the crop you want to grow, like corn, let's say, you want to maximize that through the right use of fertilizers, through the right use of planting techniques, through the right use of watering and irrigation, and all the different things you would use to maximize the growth of crops. But if you look at really innovative ecosystems, really innovative economies, societies, communities, they're not so planned. They're not so predictable. They're more unpredictable systems, like a rainforest would be, a natural rainforest versus a farm. And so if you think about on a farm, what happens when you have a weed that grows on a farm, well, you kill it. You don't want weeds on farms. If you have something other than corn on a corn farm, you actually don't want that corn. You'll kill it. But if you think about rainforests, well, what's a weed in a rainforest? everything's a weed. Everything is unpredictable. You never know if that new plant that's growing out is something that was expected or not, and you never know if it's going to grow up into the most important plant in the whole ecosystem. And so what you find in complex systems is that you have to nurture the growth of weeds. You have to allow things to spring up, to give everything a chance for life, because it could become really valuable. And you see that in places that are highly innovative. And Silicon Valley historically has been like that, where even people that didn't look right, and they were college dropouts, they smelled, they didn't come from the corporate sector, and they wanted to start something. People would recognize that and say, you know what, this might be the next big thing. Let's give it a shot. And that was part of the culture that evolved out of the Valley. Now, it wasn't perfect, of course. There are certain people that benefited from that far more than others. But on the whole, it's been very successful. You can see in terms of the output that's come out of it. And companies like Google, Twitter, Facebook, et cetera, they weren't around 20 some years ago. They were not predictable crops that someone could have planted. From an economic development perspective. They were weeds that you had to nurture from the bottom up. That is, you can't plan this stuff from the top down. You've got to nurture organic growth. You've got to grow your own homegrown crops in a way that allows for serendipity and things to happen accidentally. And so that's a very different perspective. And what that means to grow rainforests is you can't plant lots of trees and have a rainforest. You actually have to control the environment. So it's looking at the moisture, the humidity, the interaction of all the flora and fauna in the system. It's a 360 problem. It's an immersive problem where everything affects everything else. And so when you look at it that way, supporting entrepreneurial development and innovation is really a problem where everything matters. So it's not just building one company at a time. You actually have to think about the capital systems, the labor systems, the cultural systems, the networks, the infrastructure, the educational systems. All of it matters in the way that entrepreneurship happens. And by and large, we've seen this happen in lots of other places. So people who've been in innovative environments know just how important culture is. And you know that the ways that people interact with each other and think and talk and breathe and act have a huge effect on the whole system. And so that's one of the real lessons of Rainforest is to systems that are really good at planting crops can grow one type of thing that's predictable, but systems that spawn like really sustainable innovation and grow in really beautiful ways are highly unpredictable rainforests. And so when you think about building a rainforest, then you have to really approach economic development very differently. And that's what we've really tried to do. And I've been, me and Greg and a lot of colleagues have been on this journey. And over the last decade, I think we've made some great progress in shifting the landscape around how economic development is done from a world that was more industrial based to increasingly, and it's a long battle still to go, but increasingly looking at growing your own entrepreneurial innovation as part of that landscape.
Yeah, I got to say, a lot of that is really music to my ears. I've been working on this a little bit less time, but still, maybe about 10 years now coming up on. And, I see all these economic development programs that are usually run out of governor's offices, or usually run out of, bigger municipalities. They'll have a budget for that kind of stuff. And you have this problem where you have that pool of funds that then gets committed to different things or is used to lure specific businesses in a way that's much more planned, much more regimented, rather than a focus on creating that ecosystem for that organic growth. And I think sometimes those things tend to be a little mutually exclusive. And in my view, you sort of have a problem where, some of the people who are in charge of that, the policymakers, they can go to the ribbon cutting ceremony for whatever business they brought in or whatever business they gave a break to, that kind of thing. And it's very visible. It's highly visible. It's very seen, and it's sort of plays into their incentives versus the stuff that is a little less visible, that just pops up if you kind of create those right conditions. And so I find that really interesting. It's very much complementary to a lot of the stuff that I found and what we've been working on as well. So you mentioned that, it was about almost 10 years ago now that you wrote the book. I want to ask, is there any, looking back on that book and sort of how you're thinking about it, is there anything that you have seen in the following 10 years since it came out that you thought, oh, well, I didn't really predict that, or maybe I was too quick to think about this thing, or has most of what you've written about just been confirmed by the past 10 years or so? Is there anything you would revisit or maybe revise or do differently?
Even in the book itself, it talks about it as a first draft and kind of very high level view of how to rethink economic development, economic growth. And so it's got lots of details that are missing in there. So there's a lot of things, I would never have predicted around specific technologies, certainly didn't predict a pandemic, certainly predict the cultural movements that have happened, certainly didn't predict a lot of things that have transpired in the last decade. But I think by and large, the general vision is actually holding up because we're finding more and more people are gravitating towards this model, mostly because the old model just isn't working anymore. I remember spending time with people from the World Bank even a decade ago, where senior leaders of the World Bank were being told by the countries they were supposed to be helping to grow their economies, where the countries would say, you know what, we've done everything you've told us to do, these big macroeconomic shifts in our economy, and it's not working anymore. And it's because we're out of bullets in the chamber. The ways we've done economic growth in the past don't add up, and there's just not enough big corporations that are already built to go around to create enough jobs for everybody anymore. In fact, they're the ones that tend to shed jobs over time. So I think by and large, I wouldn't change the basic premise, but there's a lot that was not filled in, and the book was really meant to provide a very, very new way of thinking about the problem, which I think is borne out. I guess if anything, I was very idealistic. I've always been an optimist, and I thought it would happen faster. I thought people would basically see these ideas and think, oh, of course, we better shift the system. But paradigm shifts are tough, and going through paradigm shifts now. It was when college. Many years ago when I read Thomas Kuhn and The Nature of Scientific Revolutions, and I thought, well, maybe it's different now because the internet makes information move faster. Maybe people will be more amenable to shifting the way they think faster. And I think the thing that's held up is Kuhn was right. It takes when you're presenting an entirely different worldview to people who've grown up in one way of thinking, shifting an entire way of thinking is so hard. And I think we have found that this is a multi-decade shift in the way that society responds to the innovation economy. And it's just an effort we all have to work at. And it's one where every generation will stand on the shoulders of the generation that came before to build the work. But I think if you look back now, I think I've become wiser in the sense to realize that's just the way human society is. There's people that are always looking out ahead of the curve, and they're the ones that have to pull the rest of them along. Yeah, no, I think that's good. I think, there was a lot of promise in, the internet and knowledge and connecting everyone. And I think, we're all learning the lesson of whatever upsides there are some downsides to that as well. And we'll have to kind of muddle our way through and just sort of deal with it. It's weird to think just how new all of that still is. I remember, back before our cell phones were ubiquitous, and, that was not really that long ago. And a cell phone really meant something really different, back even 10 years ago. So we'll see how it keeps going. And it's a double-edged sword. We have some of those innovations like Square, people can, accept payment via credit card, anywhere. And that's a huge help. And so there's just a lot to consider. But I think that by and large, I can't find much to disagree with, in sort of the way you're thinking about that. I definitely think your metaphor of the rainforest has been borne out. I'm hoping that you'll find even more, sort of momentum as you talk to policymakers and as you're trying to get some of these things across the finish line. So I do want to dive a little deeper and talk a little more specifically about some of the things that you mentioned. One of the ones that I see discussed frequently, especially more even most recently, as the time that we're recording this, the Biden administration executive order is not too old. So I would like to pick your brain a little bit about non-compete agreements. So that's one area that I've seen you highlight. Can you explain sort of what non-competes are, maybe why they should be an area of concern, and what you would do to sort of tackle that problem? So non-compete agreements are restrictions that employers put on employees to say that you can't leave this job and go work for another employer that competes against us, or you can't start your own business to compete against us. And what's happened over time is they become actually there become a lot of them, and they become a real problem now. And now at least 20% of the workforce is under some kind of non-compete agreement. And for a while, people used to think of them as something for like highly trained or executive talent. And these were people that you assumed could hire a lawyer and negotiate their employment contracts to the fullest because they had that kind of knowledge and expertise and power to negotiate. But what's happened now is and this is the stories that get out around fast food workers, people making sandwiches being asked to sign non-competes, or delivery workers being signed non-competes, which means they can't leave a fast food restaurant to go work for another one, or delivery workers can't work for another delivery company. And so they become a real problem because what it does is it holds people back from starting their own businesses or working for another job. And we've seen the data that bears it out. So in Oregon, where they actually did an experiment where they actually eliminated non-competes, and people actually tracked it over time, they found that incomes went up. They found that mobility went up. It actually makes a difference in people's actual lives. And there's a lot of people that can't start businesses because of non-competes. And I've heard so many anecdotal stories around that. If you just ask around, people say, oh, I wish I could do that business, or I wish I could consult for that firm, or I wish I could do this stuff on the side, but I can't because my employer won't let me. And so you think about all that potential that's held back in the American economy, it becomes a real issue because those are things that people know best. They're areas of work where they actually have some inside knowledge, their area of specialization, and they can't actually leverage that to the fullest if they see a better way to do it. They have to stick within an older company that maybe does it a way that isn't as optimized or as valuable for society as a whole. And so it holds people back, and it limits opportunity not just for them, but for all of us. And one thing I do see is I think there's a real conflict around non-competes. People aren't even sure they know how they're supposed to believe in it, because it's actually a competition of two different forms of freedom. It's the freedom, on one hand, you have the freedom of contract, which is, well, people should be able to negotiate whatever they want. But on the other hand, you've got the freedom of mobility, which is people should be able to move around and create value in their lives and control their economic livelihoods. And those types of freedoms are in competition with each other. But I think what we're finding is, one, the freedom of contract doesn't always hold up because a lot of people don't know what they're signing, or they don't actually have any choices. They have to take a job because they have to feed their families, or they have to make a living, and they actually don't have a lot of other options in their particular situation. And a lot of times people don't even know what they're signing because it's buried within a longer contract, and it's just a term that's kind of thrown in there. And then people don't even understand the consequences of what they've signed. So it doesn't necessarily fit that old model, but we know it has a big effect on freedom of mobility. It actually keeps people back, and it keeps our society back. And so what's really interesting now is we're seeing this shift happen, and it's across party lines. The president, of course, did this executive order around non-competes, asking the FTC to ban them. Not totally clear how much power the FTC has to do this. There's probably going to be litigation that comes out of it, I would guess. But there's also been a wave of states in the last decade that have been passing non-compete bans. And even the American Enterprise Institute published a paper in last December around non-competes and how banning non-competes could really open up economic opportunity. And so we're seeing people across different parties saying, this is a problem. This is actually holding us back. It's becoming a bigger issue than we realized. We should do something about this. And it's going to be interesting to see how this plays out at the federal level as well as the state and local level, because this is an issue that it has a lot of legs because it touches a lot of people's lives.
Yeah, I've been hearing more and more about this. This is an issue that I hadn't even heard of until maybe 3 or 4 years ago, really, and it's really picked up a lot of steam since then. So I guess to play devil's advocate a little bit, I know some people, the economist Brian Albrecht is who I've seen talk about this most recently. He has an article called "In Defense of Non-Competes," and he talks about how non-competes are a contract solution to what he calls the holdup problem, right? Where you have a company that invests a lot of training and time into a particular employee, and once that's completed, before the employee or the worker or whatever can meaningfully contribute back to the business, then they can just kind of hold up the employer and hold up for more money or threaten to leave, and what that does is it discourages investment in employees from companies. And that's, we don't necessarily want to create a legal scenario where companies feel that they can't invest in their employees and invest in new skill formations for them. And this non-competes are seen as sort of a contractual solution to that. Now, once we get a little further down, into the crazy stuff like delivery drivers and, fast food workers and things like that, this seems like this makes no sense at all. It seems to me like there might be a balance between, having a legitimate need for non-competes at certain levels, but how they've just run amok, on different levels where they have no place being, So do you think there is a trade-off there? And do you think that blanket bans are preferable at this point in time?
I think there's a legitimate policy debate on, that right balance and the risks and the benefits and the cost analysis around that. No one's really been doing that, so it's good to hear that discussion. I think it'd be valuable to have it. I do see a lot of big corporations investing a lot in training, recruiting people, building them up, and I think there is a difference between kind of labor that requires a lot of heavy investment for training, and which would be almost like the equivalent to what some companies do, where they will pay for someone's business school in exchange for working for a number of years to pay off the cost of going to graduate school or something like that. That's not unheard of. I think you're right. The challenge has been where it's just run amok and people have been really told they can't, compete at all. I think the example people use most often is California, where the state of California, it was actually the Supreme Court of California said that non-competes were unconstitutional, that they were a restriction on economic mobility. And so by saying that non-competes were not enforceable, they were actually able to help be part of the growth in California. And I think it's hard to deny that California has been very successful at building very big, knowledge-intensive, labor-intensive businesses. So I think but that analysis is worth going into. But I agree with you. I think there could be something that is narrowly tailored, but we need to have that discussion, and we need to find a way to make sure that the costs of doing so don't outweigh the benefits. And I think California provides an example. I think there's a lot of data that can show that banning non-competes tends to have a much bigger effect, but there may be specific cases where you could harm companies that do it. But I haven't heard people actually engage in very narrowly tailored versions that are kind of in the lines you're talking about. There are a lot of laws at the state level that are based around either geographical restrictions or certain types of talent or certain income levels. But I think the specific thing you're talking about is a really interesting point to discuss.
Yeah, I think we'll probably just have to kind of wait and see sort of how this shakes out. I'd love to see maybe a little further down the road an investigation in certain states or jurisdictions who have either banned non-competes entirely, and then maybe other ones that have sort of curtailed them. Because it's a tough one. I mean, there's a huge problem when a McDonald's worker can't go work for, Subway or something like that because of a non-compete agreement. Like that's ridiculous on its face, but it does seem like it would be a challenge to sort of legislate how you might define sort of those different skill levels for when a non-compete can be imposed versus when it can't be imposed. So I guess we'll have to see if there's some policy entrepreneurs that can kind of come out there and really walk that line in a way that does this well. So I'll keep you posted, and hopefully you can keep me posted as well if you see any jurisdictions doing well on that.
It's tricky. Some of the great work that's been done on this is from the Economic Innovation Group and John Lettieri's group. They've been keeping track of a lot. They have great reports where they keep track of what's happening in different states every year, and I've been really impressed with that. But that's the trick and you've seen this hodgepodge potpourri of different state attempts to try to thread this thing. And I think it's just tricky because it's hard to say there's one blanket description that captures exactly the policy point you're making right now. I think it is hard to narrowly tailor this stuff.
Yeah. Well, I want to switch gears a little bit. Another thing that you all have highlighted at Right to Start and is a major concern. We touched on it a little bit before, is access to capital. And so, you discussed a little bit about the sort of the dissolution of, community banks. A lot of the community banks have just gone under. The story, as I see it, has been, we had the 2008 financial crisis, and then as part of the reaction to that, you passed what I would consider to be fairly heavy-handed regulations, and mostly in the form of Dodd-Frank, which really made the bigger banks able to leverage their size and their legal capacity to deal with those regulations in a way that smaller community banks just did not have the manpower to keep up with. They just can't keep up with it, and so. That sort of, rather than trying to become fully in compliance with these new regulations, many of them thought it was just easier to sell, and a bunch of them were just snapped up by these bigger competitors. And so now we're kind of at the point where the bigger competitors are really the only game in town as far as capital is concerned, and that puts the little guy at a really big disadvantage. That it may not make sense for the bigger competitors at scale to be taking these smaller risks. They certainly don't have the capacity and the manpower to investigate these different ideas that are popping up in the community, and so it's a lot more regimented, which means that it's a lot harder for entrepreneurs to find the funds that they need, right? And so, do you agree with sort of that analysis, or do you think I'm getting a piece of that wrong? And sort of, if so, where? So how do you view the change? I mean, we had community banks before, and we seem not to now. So what accounts for that change?
I think what you're saying is definitely a big piece of it. I think the regulatory burden, and I've heard from a lot of people involved in running small banks around the cost of that regulatory burden. It's hard to run small banks. It's even harder to start brand new ones. And I know people starting new banks now. It's just tough, and there are a lot of rules on that. I also think it's part of a bigger story, though, and I think the bigger story is around the shift in the economy and how our financial system has not shifted along with it, and that includes both the private sector and the public sector and how it's shifting. It's not that dissimilar from the story I was talking about around economic development. It was shifting from an industrial era system to a knowledge-based system. And for economic development, that's moving from the farm to the rainforest. In capital, it's kind of a similar problem, which is our financial systems are kind of industrial era financial systems. If you look at the way banking is done, if you look at the way venture capital is done, as successful as both of those industries have been, their business models were basically built in the 70s or earlier, and they have not fundamentally changed that much since that time. The basic financial products and services they offer are 50 years old. And so what that means, if I think of the financial sector as kind of like, for entrepreneurs, it's like walking to an ice cream store with two flavors, banking and venture capital. And if you look at the data, venture capital serves less than 1% of new entrepreneurs. Banking serves about 16% of entrepreneurs, which leaves over 83% of new businesses that actually are not served by either banking or venture capital. And what do they rely on? They rely on their credit cards, home equity lines, money from friends and family. They are not able to access the private financial markets. And what that points to is, we think of ourselves as having a highly innovative economy. The question is, why can't 83% of entrepreneurs actually find any kind of private financial services in the financial markets as we think of that? And it's got something to do with a mix of private and public barriers that have inhibited that. And a lot of it's from shifting to this new system. So for instance, if you think about the breakdown between banking and venture capital, they're kind of opposite ends of a spectrum. So venture capital on one end is for very high growth businesses, businesses that are trying to hit, $1 billion or more market opportunities. They need to hit, when venture capitalists invest in businesses, they're looking for 10x the value build or 10x return to justify all the losses. And so it ends up being a very small sliver of companies where they're trying to build that kind of huge exponential growth. On the other hand, banking is highly regulated, highly conservative. It requires assets to be securitized as part of a bank loan, and they look for multiple years of revenue records to be able to provide bank services. And so that tends to be old line businesses that have been around a long time doing asset heavy businesses. So if you think about the businesses that are really getting built today, the innovative ones, they don't have a lot of assets. They're nimble, they're brand new, they don't have a lot of financial records, they don't fit the banking model. Most of them aren't like exponential growth businesses. They're businesses that can be great and they could potentially employ tens or even hundreds of people, but they're not going to be $1 billion, market cap business. We don't actually care about them in the financial marketplace that much. And so the challenge then is, how do we deal with that? And so what that means is we either have to expand venture capital a lot, we have to expand banking a lot and change that, which is happening now, and you're starting to see movement on there, or we can invent a whole new innovative array of financial products and services for that 83%, which is where I think a lot of that shift's going to come from. It's much easier to invent new stuff than to shift like highly entrenched and regulated industries like banking is, and venture capital has got its own models as well. But we're seeing in that middle space things like alternative-based models, like revenue-based investing, profit-sharing models, fintech models, and they're happening all over the place, and they're actually becoming more and more legitimized in the market. If you look up the terms revenue-based investing, revenue-based finance, flexible venture capital, you look at neobanks, the digital banks that are being built kind of on fintech platforms, you'll see just this wave of amazing activity that's happening. What we should be doing is loosening the barriers for those folks to be able to do this work better and faster and cheaper. And I think that's the innovation that's going to be happening in the coming years, is how do we allow the entrepreneurs that invest in entrepreneurs to be successful and to support that kind of financial innovation.
No, that's really exciting, and really I'm just happy to hear that, because I think you're dead on with sort of the bank model versus the venture capital model, and it's just really not a lot of new businesses are going to fit that super well, and it's really exciting to hear that there's a lot of things flooding that space. So I kind of want to dig into some of those details a little bit more about some of these new ones. Some of the stuff that I'm excited about is when I see sort of the innovations in sort of almost like crowdfunding for investment, which I think is great. Like, why can't, if I have a neighborhood block and, if there's some commercial activity or something, and, somebody in here wants to start a small business or have a home-based business or something like that, as neighbors, we can come together, and, I'm hoping, maybe there's some platform we can use to kind of come together and invest in that, just even hyper locally like that. And there is some, I know that the crowdsource funding and investment has been gaining some ground recently as well. And then you mentioned, I've seen in some of your materials and your field guides for policymakers, you have some talking about the revenue-based revenue sharing models that you were talking about, profit sharing, and then even some of these nonprofits being able to get involved too and sort of sell those portfolios to more traditional banks, which maybe as a nonprofit being able to kind of be the middleman there, they can get around some of the risk aversion of the bigger banks, and let them have the time to grow, so that becomes an attractive investment for these larger banks that are incredibly risk averse. So can you describe a little bit about how nonprofits are playing a role here, or how they might be able to play a role, or sort of what you're seeing on the ground, and sort of maybe if there's any place that you think, or even a specific venture that you think is doing this really well and really right, I'd love to hear more thoughts on that.
Sure. I kind of think of it as like a plumbing problem. So where the financial markets do well is where the pipes are really big. So if you think about, where the public mains are, where the water flows really big through the big pipes, we have an amazing financial market system for moving huge amounts of capital through big fat pipes very well. The problem is where the pipes get skinny, such as coming to your house or even inside of your house or to your faucet, where actually those pipes get very clogged up because people don't pay as much attention to where the pipes go inside your house. So we've got a plumbing issue where the smaller the pipe, the smaller the check size, the smaller the amount of money, it actually gets harder and harder because the systems don't care about the small amounts of water, but we care about the big water mains. And so what that does in effect is that actually makes it harder to get small checks to the little entrepreneurs who could become great entrepreneurs someday. But when they're starting out, moving check sizes of $5,000 to $50,000 is almost impossible because banks actually lose money for if for banks to do a $100,000 loan to a business cost them $100,000 over 5 years to do it. So to move small amounts of money, small being sub $100,000, is just something that most of the financial system doesn't care about. So the reason that nonprofits and for-profits are really important is the nonprofits actually they care about the small pipes. And a lot of these, they don't make a lot of money. In fact, a lot of them are break even or net zero. But that's what their focus is, getting the small pipes and the plumbing system down to the home, down to the faucet equivalent. And what tends to be missing, though, is the intersection of the pipes. So one of the really interesting models you mentioned around nonprofit investors. So there's a whole network of nonprofit investors for microloans, sub 100K, called community development financial institutions. These CDFIs do loans that are small sizes, but they tend to lose money or at very best break even on these loans because it's just expensive to run those, and you lose a lot of money working with little entrepreneurs in high risk businesses. There's a new fund out there called the Entrepreneur Backed Assets Fund, which I helped seed when I was at the Kauffman Foundation. And what they do is they actually buy up these nonprofit microloan portfolios. They help upgrade the underwriting standards, so the quality of the loans, so that they're commercial bank standards. So a Chase or a JP Morgan or Citi could actually buy those microloans, and then by upgrading the standards, they can now sell these pools of microloans to the large commercial institutions. And so they effectively connect the plumbing between the big water mains and the little faucets, if you will, in the financial markets. And the Gates Foundation just put a chunk of money into this Entrepreneur-Backed Assets Fund. And they're raising money right now, I believe. And if you think about it, it's not that different from like what Fannie Mae did for the mortgage market back in the 70s. I think they started in the 70s and 80s. By creating liquidity, by moving the money faster within the system, you're actually able to get more money back into the entrepreneur's hands. So money recycles faster, and you're able to legitimize it in the eyes of the public institutions, the large financial institutions, rather. This is a big problem because and anyone that's actually trying to raise a fund knows, if you're trying to raise a new venture capital fund, let's say, if you're raising something less than $100 million, Wall Street doesn't really care. Like they basically say it's not worth the transaction cost of helping invest in a $100 million venture fund. Well, almost all the venture funds outside of California, New York, and Massachusetts are under $100 million, which means Wall Street doesn't care. They might say they would invest in it if it reached $100 million, but to get to a $100 million fund, you need to start with a $5 million fund or a $20 million fund or a $50 million fund. And so essentially it's getting smaller pools of money down where the risk appetite is different, where people are actually willing to break even, is actually how you start to open it up. And that's where the nonprofits can really play a role, is where you have pools of money that are willing to break even, connect to the pools of money that are trying to catch the upside, that you can start to truly unlock what a lot of the potential is between the smaller amounts of money and the larger amounts of money, where they move, they think in terms of billions and trillions, not in terms of hundreds of thousands or millions. Those orders of magnitude are really important because that's a lot of where the breakdown in the system happens. Yeah,
that's super exciting. I mean, I'm really, really happy to hear that kind of thing is happening. I do wonder a bit if it might take a little bit of a shift in terms of a philanthropy mindset to understand that investing in nonprofits that are designed to help connect the plumbing, as you're talking about, that's just as important of an economic development program as, maybe cutting a check to an organization that's more direct services, and that's, so I don't know, maybe that'll take a little while to kind of shift and come around, but it sounds like some of the bigger philanthropy, sources are getting involved, are very attuned to that issue. So I hope that kind of mindset can kind of flood out to some of the more smaller dollar philanthropists out there who are looking to make a difference in their community, and sort of they can recognize that this is a really important way that they could make a big impact locally as well.
It's happening, but it's not easy. And I would say you're right. The traditional philanthropic mindset is invest into programs with direct services it's like you were saying, they can do ribbon cuttings. You can see the direct impact. You can track metrics better. This kind of big financial change stuff is hard. And even within a lot of philanthropies, it's the really innovative risk takers within those philanthropies that are doing these types of things. But there's a long ways to go for sure. And you're right, it would be great to see more and more of the philanthropic dollars move into that space where they're really looking at building the financial plumbing system itself, rather than just investing into direct services, which never end. You know, you invest into one set of services this year, you got to re-up that for next year. And it's what you want to do is just shift the plumbing system itself, not just throw water into the house, right?
Yeah, exactly. I'm excited about that shift. I think we're seeing a little bit of that as far as more international sort of economic development stuff. Whereas, the older model used to be, we'll flood these areas with, free food or free clothing or things like that, which really had a detrimental effect on some of the clothing entrepreneurs in that area, or, some of the entrepreneurs who are investing in restaurants and things like that locally. They have competition now and they're trying to compete with free, which is always difficult. But now we're kind of seeing a shift towards these sort of microloans, right? Where you have the guy who's, really great at, some one thing or another, but he just needs a little bit of money so he can invest in the wagon or something like that. Or just, some of the most basic capital investments can really make a huge deal on some of these developing economies. And so you're seeing those microloans kind of go out there. And so, and it's exactly what you're talking about. It's about connecting sort of the capital flows. What you're doing, you're connecting these people to financial markets. You're connecting them to markets. And that's super important for their own development. And it's not in a very highly regimented way. It's sort of letting whatever happens. I think I'm excited by all these developments. I'm happy to see that shift happening internationally, and also now, in the United States too.
It reminds me of what you're saying around this documentary, Poverty Inc. I don't know if you've ever seen this documentary, but
yeah, love that documentary. We have several of the contributors to that are on our board at the Archbridge Institute. And so that's definitely been a focus of what we've been trying to work on, as well as trying to maybe translate some of those lessons and see how they work in a more domestic context. But yeah, I'll put a link to it in the notes for anyone who hasn't seen it. It's definitely well worth your time.
It is great. And because it talks about the dangers of free, instead of trying to fix the plumbing, you're just trying to shift, trying to put a bunch of water into a household. Because it becomes not sustainable and actually causes harm to the whole system. But the one thing that came out of the documentary I thought was most interesting is the one thing that did work was helping the entrepreneurs, like actually helping people figure out how to make stuff, create a living, sell stuff. That sustains itself over time and actually is what the local people want. Like they don't want free. Yeah. They want to empower the entrepreneurs who are already doing the stuff. And the more it makes me think a lot around like emergency response, and instead of flooding the market with lots of free stuff, could entrepreneurs be part of rapid response to crises and disasters? And we've seen in almost all markets where there is some kind of disaster, where there's a flood or a hurricane, it's usually entrepreneurs out front who lead the fixing of it, but they're usually not the ones who receive a lot of the philanthropic support out of it.
Yeah, that's very true. And I think that entrepreneurs, they're playing this major role, and anything we can do to sort of at the very least get out of their way, and try to empower them and get them closer to the markets that they need to be in. Well, I think that's good. I think, one thing I wanted to shift gears, probably the last sort of more policy specific thing I wanted to kind of pick your brain a little bit on. One of the things that we work on here at the Archbridge Institute, it's probably the least popular policy, idea that we have, policy proposal we have. But we've argued a lot against raising the minimum wage. And as I'm sure you're aware, obviously for smaller entrepreneurs, for new businesses, the minimum wage is a lot harder to absorb than some of the bigger guys. Most recently we've seen Amazon be part of the push for a federal $15 minimum wage, which of course, they're a major player. They can afford that, whereas a lot of their competitors are going to struggle to afford that wage increase. And so we kind of have adopted the stance that minimum wage hikes are probably not a good idea in terms of entrepreneurship. But if you're going to adopt them, try to keep it at the most local level rather than doing, a statewide thing or even worse, a federal thing. Obviously, markets are different in New York than in, Biloxi, Mississippi. And so I'm just kind of curious, have you guys looked at that at all? Is that an area of concern that you've been engaged on at the federal level as well? Or is that something that's kind of in the background?
We haven't fully engaged on that at Right to Start just because, as you're saying, it's really contentious and there's so much nuance around it. But I agree with your point, which is, what's considered a minimum or a livable wage in Los Angeles is very different from what it would be in a rural area or a small town or a mid-sized city even. And trying to create a blanket number, there's no one number that fits across the entire country. And that just becomes really problematic to say that there is one standard for what we consider, a basic livelihood. I'd say the bigger issue we've tried to take on at Right to Start is this, which is, I think the debate between our economic debate tends to be between employers versus workers. And I think that's like a 20th century old industrial age fight. And we need to shift beyond the idea that it's companies versus workers to the idea that everybody can be a company. Everybody, people are the new companies in the 21st century. Any one individual can, they can be working a 9-to-5 job, but in the evenings or the weekends, they could be doing a side hustle, launching a Kickstarter project, selling a service to their friends or their neighbors. And that side hustle or weekend project could become their big thing, and it could take off, and it could actually start becoming their full-time job, and it could start eventually growing and hiring people. And I'm not just making that up. I've seen that story play out over and over and over again, that today's employee is tomorrow's entrepreneur that becomes tomorrow's company, that becomes the worker, that's the employer that sustains livelihoods for dozens of people. And that's kind of the American story. We need to appreciate that the battle between a company versus a worker is just antiquated, that we need to move into an economy where everyone has the tools to create and build and make their own futures. And that's a shift that I think is going to be tough, because I think so much of our public discourse and our policy debate is in that old mindset that it's them versus that, and I think that debate is one of the reasons we've stayed out of the minimum wage debate, is because I think that just gets us into that debate. And we just don't want to get into that debate, because the future is different. The future is about empowering people, not about picking winners and losers and carving up economic outcomes. We're really focused on empowerment and really trying to shape the discourse for the 21st century.
Yeah, that's encouraging. I think you're dead on right. Everyone out there has the opportunity. Especially with technology, I can't tell you how many people, they make crafts and sell them on Etsy, or, a lot of people, get upset with Amazon. There's some discussion on the federal level about, are they being monopolistic, that kind of stuff. But at the same time, they're connecting, very small entrepreneurs to a huge market, a market that they probably would not have access to on their own if not for the Amazon platform and that kind of. And so, I love the idea of side hustles becoming main gigs and trying to let people know that they are in control. They can each person their own company. They can do that, and so I'm excited to hear that. So. Well, kind of going back to some of the things that we touched on a little bit earlier in our discussion, we talked a little bit about the Biden executive order in the context of non-competes, but more generally, how do you think the Biden administration has done so far in terms of looking at entrepreneurship, or, maybe you can keep it, I know their big executive order on competition, where they were encouraging states to look at occupational licensing reform, which is something that's been a major topic of discussion for us at Archbridge as well. So how do you think the Biden administration has done so far, and sort of what can you expect going forward? What are you expecting going forward from them?
It's so hard to say, and we're nonpartisan at Right to Start, so we really work across the party lines on this issue. I would say the really encouraging thing out of the Biden executive order was that they highlighted this issue of entrepreneurial decline as one of the main reasons to drive for this executive order. That's the first time that I can recall that any White House has talked about the decline in entrepreneurship as a crisis in the country. And that's very exciting because it means that this issue now is getting elevated as kind of a call across the country, where that means the government, the bureaucracy can start to rally. They kind of know that that's an issue that everybody needs to care about. What we found, and we've been doing work at Right to Start at the state level in working with across party lines to build initiatives to drive policy reform and advocate for better laws to help entrepreneurs, is the parties don't actually know how to think about entrepreneurship. Like, this is all greenfield. Like, it's not like you can say non-competes and you immediately know what side you fall on. It's not like you can say even regulatory relief. And now you can see that as like a progressive issue in certain areas as well. People are talking about this in ways that fall outside of a lot of traditional party lines. And so what I'm really hopeful is we can actually shift both parties in this direction, that this becomes an issue that transcends party, because there's so little that the parties agree on these days that it'd be great to have an issue like this where people can actually have common cause. We just don't have common cause on a lot of stuff. But this is one where the data shows how important entrepreneurship is. We know that there are parts of both parties that care about this issue deeply. We know it's a crisis level problem. So let's actually rally people around it and actually drive change. It'll be really interesting to see how not just the president, but also governors and state houses across the country respond. What we found is they actually don't have rigid lines on how to vote on these issues. They don't have a lot of pre-decided positions on these things, which is fantastic. Like, we can actually reinvent how people are supposed to think on this, because they've never actually had to think about it before in this way. And so I'm excited about that prospect. And I hope people across the country take the opportunity to rethink, what do we vote on? What do we believe in? What change do we fight for off this lens? Because it's a brand new lens that can matter a lot for us.
Yeah. I've been encouraged by a lot of that as well. I mean, even working in the state level is probably where we do most of our engagement. And that, it doesn't easily, fall across party lines and things like that. Occupational licensing reform and having states look at that has always been a really bipartisan, thing. And most state lawmakers, whether they're Republican or Democrat, are interested in solving these problems. Of course, we have newer problems of it's more like incumbent businesses versus, potential new competitors. But that has really nothing to do with the partisan divide, which is both encouraging, but also presents some of the new challenges as well. So you mentioned, working with states and trying to get some of that. I know some of the state level stuff that you've been working on is these Right to Start bills. So can you just briefly describe what that is and sort of what you might encourage states to do in terms of entrepreneurship?
Yeah, we were very fortunate in the last few months in the state of Missouri. We were able to get the first ever Right to Start Act passed through the Missouri House. And it's the most comprehensive state legislation for entrepreneurs ever proposed. And what's really unique about it is it's not just one little issue, which I call whack-a-mole. It's like it actually covers a range of different pro-entrepreneur issues, from non-competes to lowering taxes, to creating an Office of Entrepreneurship, to dedicating 5% of government contracts to young businesses in the state of Missouri. So that's a whole range of issues that could have a huge effect on entrepreneurs in the state. And so we're gearing up for the Missouri Senate in the next cycle, and we're excited because we've got that momentum going. But we've actually heard from a lot of other states that have raised their hands and said, yes, we'd like to do something similar as well. And it actually is from both parties. And it just shows that this is kind of ripe. We're kind of at that moment where people are looking for a new cause to believe in, a new set of ideas to fight for. And so we're actually getting ready for the next legislative cycle, and we're starting to gear up for that and advocate for policies, working with state legislators in a bunch of other states now to start to explain these issues, educate them on them, and show that there are ways to do this better than states have done them in the past. Yeah.
That's exciting. I'm really happy to hear that. Congrats on working with the Missouri legislature to get something at least rolling. And hopefully that all comes to fruition in the next cycle here. Kind of staying on this topic, I do have. So we can kind of close on this question here. But if you had the opportunity to talk to every state lawmaker in the country, and you really only had about a minute or two to communicate your message to them, what is it about entrepreneurship or business dynamism or new business or or innovative ecosystems, what is the key point or key points that you would want to communicate to them?
America was born as a startup nation, but we're in crisis. We're in a startup slump. Entrepreneurship is declining, and it's the source of jobs and income growth and fighting inequality that we have not paid attention to. And so there's actually an issue that can actually affect the voters in your district and actually raise the quality of life in a very tangible, very practical, very direct way. And there's a chance to actually lead on this thing and actually work across party lines to drive change in a way that almost no other issue quite fits this. And so it's a chance if policymakers want to be out front, they want to lead and want to deliver real value to their constituents, there are people that care about this, and there's a real chance to do something innovative and impactful. Well,
I think that's a great place to end it. So, Victor, thank you again for coming on and talking with me today and taking so much time out of your schedule to do this. We'll certainly keep looking and watching what Right to Start does and what you guys do, and hopefully we'll have you on again to talk about all your success stories.
Well, thank you, Ben. Really fantastic. Thanks so much for the opportunity to talk with you, and really look forward to continuing to stay in touch and work on these issues together.
Sounds good. Thanks a lot.